Hiral will join us in just a bit on that one, but I'm going to go across to Mayuresh Joshi, fund manager at Angel Broking, to talk us through this market. Mayuresh, how terrible has this week been? The market just want to forget about it?
Well, absolutely, Anupriya, and clearly I think it's sheer panic on the street at this point of time, and you're not really sure on which points you're probably working. The global data points are pointing to a lot of mixed data coming through. You're not sure about how the recessionary trends are panning out in the US, if they are. And clearly, I think Janet Yellen's statements again creating a huge amount of uncertainty. Couple that up with what's happening in China, crude, what happens with the Japanese markets is all playing on the global scale. Domestically, again, I think earnings not up to the mark expected. Capital cycle, credit growth, I think taking time expected. But clearly, I think the markets are mirroring what is happening in the global markets, and you're probably hostage to the global situation at this point of time. So it's sheer panic on the street at this point of time, specifically for the Indian markets.
I'm going to bring in my research team here as well, and we'll talk about some good news and the really bad news as well. Hiral talks to us about M&M, which just reported numbers. She has the luck to talk about the two counters that are actually doing well in trade today, Tata Motors and M&M. And you've got Shraddha standing by with Wockhardt numbers that are dismal at this point, and she's waiting it out for Sun Pharma patiently as well. Hiral, let me come to you with M&M first up. How are the numbers looking?
So in terms of the numbers, if you go to see, the top line is pretty much in line with estimates. However, the margins and profits are below estimates in terms of the standalone as well as the consolidated number. If you see the total income up by around 17% on a standalone basis, profits down 14% at 808 crores versus an estimate of 904. And if you see, they did see an exceptional gain of close to 63 crores in this quarter, and margins have improved and come in at 11.3% versus a 10.5. However, streets were expecting a higher margin of close to 12.64. If you see in terms of the automotive segment, that has been pretty good for the counter. However, the farm equipment segment has been slightly under pressure, where if you see the revenues there, they have been up by a meager 4%. In terms of the segmental returns also, if you go to see, the automotive segment has seen a margin of almost 8%, and in terms of the farm equipment segment, margins of close to 15%. On a consolidated basis also, if you go to see, the total income is up by around 15%, wherein the number is slightly below estimates. And if you see in terms of where the profitability is concerned, down by around 15% again at 821 crores, wherein we did have a consolidated estimate of close to 964 crores, and margins have improved again, however slightly below estimates at 13.7%. The UV business is showing some signs of recovery, mainly by new launches, and the volumes are up by around 17% on a year-on-year basis. Even the PV business has shown some bit of a recovery with volume growth of around 14 to 16%, and this is a double-digit growth in the PV segment for M&M after 14 quarters. And in terms of where MHCV is concerned, that has continued to grow mainly on the back of replacement demand, and tractors have remained subdued mainly on the back, and they've seen a degrowth of close to 1.5%. So all in all, if you go to see, numbers are slightly better on a year-on-year basis. However, if you compare them with the estimates, they are below.
All right, Mayuresh, before I get to Wockhardt with Shraddha, how is the auto pack looking to you after these earnings season? Tata Motors are also on the upside today.
No, clearly, I think one needs to be selective within the four-wheeler pack. And if you see M&M numbers, I think top line more or less in line with estimates. The EBITDA did disappoint a tad bit, but clearly, if you look at the larger picture, you're probably looking at the UV segment holding pretty well. The PV volumes were up significantly. And again, I think the new launches is something that might upset them from a medium to long-term perspective. Farm equipment solutions, specifically the tractors business, was always a question mark for M&M, considering the kind of weak monsoons we've witnessed for the past 2 years. But again, there is a lot of hope in terms of monsoons being quite stable and reasonable in this year as well. So clearly, I think you're talking about a improvement on the base effect, which might be quite humongous for M&M. And again, valuations are looking attractive. So I think we maintain an accumulated rating on the stock, though I think we'd like to hear about the management commentary related to volume growth, related to PV, UV, as well as the tractor segment going forward.
All right, Shraddha, Wockhardt, it's been an unhealthy quarter for them.
Yes, very weak set of numbers coming in as far as Wockhardt is concerned. So net sales are down 22%, EBITDA margin is just 7%, and net profit down 82%. So what really went wrong? Well, it was a muted sales and a much higher R&D expense for the quarter that led to those depressed margins. So R&D as a percentage of sales stood at 14% versus 8.6% in Q2. Also last year in UK there was a one-time contract benefit which was absent in this quarter. Also India sales came in pretty lower than what the analysts were estimating. So all of this combining leading to that weak set of numbers that are coming in. Macquarie has actually maintained their outperformance on the stock, nevertheless cut their target price by a steep 25% to 1530 even as they focus on FY18 numbers. So they've said that they assume the first full year of contribution from Shendra facility only in FY18 now, and they expect EBITDA margin improvement to come in FY17 onwards, driven by US business ramp up and better asset utilization post the US FDA issue resolution. They've left their FY18 numbers unchanged. However, given the significant ramp up in the near-term R&D expenses and the emerging market headwinds, they've lowered the FY17 EPS estimates from 75 to 55. They've also lowered their valuation multiple from the previous 20 times to 15 times. So overall, a price cut coming in even from Macquarie.
Shraddha, quickly run us through what you're anticipating from Sun Pharma as well before we pose the pharma question to Mayuresh and how he's playing that sector.
Well, this is going to be the fourth quarter of reporting consolidated numbers with Ranbaxy. Nevertheless, supply issues at Halol as well as the pricing pressure in the base US business is expected to continue to impact the core sales and margins. So if we just run through the numbers, revenues are expected about 7,052 crores, EBITDA expected at close to 100 crores. EBITDA margin should probably see some improvement at least on a sequential basis, and net profit seen at 1297 crores. So a sequential improvement is something that we're really looking at, and on a year-on-year basis, Sun Pharma sales numbers should come in absolutely flattish, but we could see some PAT growth on account of the low base in Q3 FY15. Even if you look at the geographical performance, domestic formulations likely to post just a single-digit growth of close to 7%. US-based business again likely to see some decline on account of the Halol supply issues and pricing pressures. Nevertheless, a good set of numbers from Taro that we saw yesterday could lead to some bump up as far as the US numbers are concerned, and overall on an overall basis, emerging markets should also see some impact of the currency headwinds coming in. So the key thing to watch out for definitely is going to be the clarity with respect to the Halol plant reinspection timelines and any management commentary in terms of the Ranbaxy integration and overall business outlook.
All right, Shraddha, thanks for that. Mayuresh, pharma, expensive and a lot of US FDA concerns across the board on some marquee names as well. But is it one of those places that you can protect your capital or not anymore?
Not really sure about protection of capital, but clearly I think valuations for the entire sector are a tad bit higher, and again I think they've traded over the past few years because of the kind of earnings momentum that you've seen in a lot of pharma stock. Having said that, I think as you rightly pointed out, I think a lot of these FDA concerns are getting played out on a lot of these stocks, and these concerns might just stay there at least for the better part of FY17. So I think we've still not rolled over numbers to FY18, but whatever we see over FY17, I think we're expecting a stock-specific approach on this sector. Sun Pharma, as you were mentioning, I think is one of our preferred picks from the top-tier pharma names. I think a lot more has happened to the stock price. I think whatever happens with the network integration issues with Ranbaxy, the Halol plant remediation issues have played out on the stock price in our opinion. I think the numbers are expected to be soft, not just for this quarter, but even for the coming quarter as well. So clearly I think approvals, how the US business does, how the domestic formulation business does, is something that we'll watch out for. But again, I think our own estimates are anywhere between 7,000 odd crores on the top line. You're probably assuming a 27% EBITDA margin to come through for this quarter. And valuations have contracted quite meaningfully. So Sun Pharma remains one of our preferred picks.
34 crore profit versus 200 crores in the previous quarters, in the same quarter previous year, versus about 251 crores of profit in the previous quarter as well. That's the number for Andhra Bank that comes in. Provisioning, And let's see how that's done. 905 crores versus 524 crores. Substantial jump in provisioning as well, probably under the AQR, the asset quality review. The gross non-performing assets have jumped from 7,470 crores to 9,520 crores. So 2,000 crore jump coming in on gross profit number, where you've got the gross NPA percentages rising from 5.7 to 7%. Even on a net NPA basis, 2.95 to 3.8%. Stock punishing that. We've seen this across the board in most PSUs. The big question is, how do they handle this kind of deterioration of the book? Mayuresh, I won't ask you on valuation and if you would be brave-hearted enough to go into PSU banks at this point. What I'm looking to understand is, if your provisionings are so high, your book is looking so bad, you can't complain about demand being low, because I assume they don't want to give money out at this point because the return on capital is very low for them. How do banks even move forward from here?
No, clearly I think they are having 2 or 3 issues. Clearly I think asset quality is plaguing a lot of PSU balance sheets, and again I think if you go by the numbers that have reported, I think the pain might continue for the better part of the next quarter as well. Having said that, probably I think you're probably looking at, if the credit growth slows down or it is not up to the mark in the coming few quarters, you're probably looking at an elongated cycle of working capital constraint pain for the end user industries to whom they have lent, I think still continuing on their balance sheet. So I think the provisioning might still be a little bit higher than what a lot of analysts on the street have assumed. It's very difficult to probably pinpoint what kind of provisioning and write-offs might probably happen, but the deterioration that you've probably seen on the book is very, very evident. When it comes to credit lending, probably I think you're still seeing weakness happen on that front, and clearly it's the working capital supply that is still moving on. So I think in terms of fresh credit, I think extremely selective. It's not just the PSU banks, but even the larger private sector banks who have a corporate exposure. So one really needs to understand in greater detail, even over the next quarter, how the management perceptions are for the coming fiscal and what they're probably looking in terms of earning growth, credit costs, in terms of provisioning the restructured pipelines. I think there are too many parameters that one really needs to look at, and though evaluations are looking extremely attractive, I think one should still wait and watch for further clarity to happen on all these issues.
Andhra Bank at the day's lowest point. I saw Apollo Hospitals reporting numbers as well. Mayuresh, thank you so much. We'll let you go. The earnings rushes will continue. If I keep taking them one by one, you'll be sitting with us for a very long time at this point. Apollo Hospitals reporting on a net basis 109 crore profit. That's above the 86 crore that the market was working with, and the market's rewarding that to Apollo Hospitals right now. The net sales comes in at 1,380 crores. It's a shade below the 1,400 crores that was the consensus estimate at this